the old company is going down.
They are capitalists.
Yeah.
There's no charity. It actually creates jobs.
It's about the money.
It's about money. Love it or hate it.
Love it or hate it. Toys R Us and Chrysler, both in bankruptcy due to private equity. So that's what we're going to talk about today. Is private equity really that good for a company? And how does it actually work in private equity? That's why we have our business lawyer here today.
Hello.
So we're going to clear this out, and she's going to explain everything that we need to know about private equity.
And it sounds like you're not a fan.
No, I'm not.
No. So many are not. Many hear about asset stripping, about tax avoidance, about good companies turning bankrupt, etc., right?
Yes, and private equity ruling the world, the economy.
I like private equity.
You do?
I like it.
Well,
I work with it.
show me wrong.
Yeah. So we're going to do a one-on-one what it is, and then we're going to talk a bit about why it has such a bad rap.
Yep.
And both what's legit and what might be exaggerations.
And that's why you need to watch this episode and subscribe to our content, because it's so good to know that we discuss this and you can take your own decision.
Yeah. So private equity, number one, we have a fund structure, a fund with a limited lifespan.
Yeah.
Where we have the managers, the GP, the ones that deal source, that find the investments and do the exit from the investments.
Yeah.
And then we have the passive investors, who's the LPs. We remember from venture capital, right?
Yep.
Same structure.
Yep.
Yeah. So LPs, investing, GP, managing, often also required to invest something because you want them to have skin in the game. Limited lifespan, perhaps 10 years, 12 years. Same again, right?
Yes, we have an episode about the differences between venture capital and private equity. So watch that one.
Yeah, we do. And then we have that they invest in more mature companies that they buy, because in venture capital, we're talking about investing into the company. Here we talk about buying secondaries, either taking a company off the stock market, making it private, or finding a private company and buying it as a whole, acquiring it, or the majority of it at least. So they take control.
Okay.
Venture capital, again, we said take a minority stake, invest in the company. Here we buy it, we take control. So in venture capital, we're very founder-centric. We want to take care of the founders. In private equity, we typically want our own management team. We might even kick someone out on the way. And then we have a waterfall structure. Again, same as venture capital.
Okay.
Where we have the committed capital is given back to the LPs. Then we have a preferred return going to the LPs. Then we have a catch-up, where the fund manager starts to catch up because we have a 80-20 split on the remaining full carry profit mode.
Which is the same in venture capital.
Yeah.
Okay.
So we call it the 220, where 2 is the management fee and 20 is that profit split if the waterfall allows there's enough sufficient cash left when you close down the fund that the investors get theirs with the preferred return and then you profit split. Yeah.
Okay. Really good to know.
Really good to know. And as they go for more mature companies, you can say that they are typically also don't have the same risk or the same exponential growth. So to compensate for that, they use leverage finance, because that's a kicker on the return on investments. It's high risk, but it's also a kicker, right? So how does leverage finance work?
Yes. Explain it.
So let's say we have a fund of 10 billion, because that's a big fund. And then we get a 2x return. When the fund is done, you sell our own companies, you get a 2x return. So you have 20 billion, right?
Yep.
So we're going to skip preferred return and we're going to skip interest rate now, just to paint out the picture about leverage finance. So we have 20, we give 10 back to the LPs, right? Then we have 20 split. No, sorry, we have 10 split. We had 20, 10 back, because 10 was committed capital. And then we have 10 left to split. Okay?
Yep.
Again, and not even accounting for the preferred return. But what if we have the same fund with 10 million committed capital in, and we borrow 40 million, right?
Yeah.
And we still then we have 50 million to play with, make investments with, right?
Yep.
Instead of 10, we have 50. And then we still make a 2x return. Then we have 100 right? So on that 100, again, we'll need to pay preferred return and we will need to pay interest, but that aside, then we give 10 back to the LPs, we give 40 back to the lenders, and voila, we have 50 billion left to profit split up.
Wow.
Because we increase the base, but the lenders will get their money back and the interest, but they will not be part of the profit sharing. That's why it's leverage finance.
Okay.
So in the first example, it was 10 left. In this example, it was 50 left. But the committed capital was 10 in both cases, right?
But it's a big difference with the money.
Yeah. But and then we can also ask as a final point, how do they do the value growth? How did they get to 2x? So, and this is one of the reasons why private equity gets a bad rep. Because one thing can, of course, be cost cutting. They know cost cutting. Another one can be asset stripping. And that's where you take the assets of the business and sell them in portion. And suddenly you have this naked business having to pay and rent everything, etc., or lease everything because it has no assets of its own. So sooner or later it erupts. But the private equity firm might have made a good deal on that asset sale. And also, as regards to leverage finance, there's a lot of critique about where does the leverage go? Who takes the loan? Is it the fund or is it that poor little company that ends up paying the bill? So that's, and then the last one, why they get a bad rap is, of course, tax evasion, because they're known to be situated in tax havens.
But not everybody does that.
No, not everybody does that. And I'm not going to say that that's wrong. Neither the asset stripping, the cost cutting. They, of course, also do a lot of mergers, M&A, deals, buy and build. So that's how they get a bigger value before they exit. But why do I like private equity?
Yes. Why do you like it?
Because it actually nurtures the economy also. You need to be mindful that it actually creates jobs. And old stale companies get new lifeblood and they might go belly up anyway. And suddenly somebody comes and places demands on them that you need to level up. Perhaps you can't function like you did 25 years ago. So they actually pump money into the economy also and actually stimulate also. And they also provide healthy competition between companies because you can't be old and stale. So,
I mean, a lot of things happen when private equity comes in, a lot of differences in the company. And that's why people are, no, the company is going bad or the old company is going down. But I mean, it's a big change. That's what happened.
And they are capitalists.
Yeah.
So there's no charity. There's no little heart between an old brand name if they ain't carrying its weight anymore.
It's about the money.
It's about the money. Love it or hate it.
Love it or hate it. Thank you.
Thank you.
And I understand you like private equity.
I do. I'm not saying that they're all nice guys, but I'm saying that there is a healthy injection of innovation, of healthy competition, and money into the system.
Really good. And that's why we made this episode, so you can see, I mean, choose which side you're on, and we just describe the difference.
Or do you think I'm completely wrong?
Yeah. You can just write in the comments whatever you think or your thoughts about private equity. Would love to know what you're thinking. And today, this episode is powered by Gold Venture Investments.
Gold Venture Investments.
So thank you so much for having us. Remember, this is not legal advice. It's knowledge sharing. So buckle up with all this knowledge. Like and subscribe to our channel. Be the smartest person in the room and know how to run a business. And share it to the people you like. Because the business is going to keep rolling.
It will.
Yes. Thank you.
Thank you.
Hej då.